The costs of operating assets are allocated as expenses to future periods in one of three ways: depreciation of tangibles, depletion of natural resources, and amortization of intangibles. Depreciation can be a product cost or period cost. This means that the cost can be expensed as part of cost of goods sold. An example is depreciable manufacturing equipment, or it can be expensed in the current period as depreciation. And if the asset is expected to have a salvage or residual value when disposed of, that part of the cost is not depreciated because it will not help to produce revenues. Different allocation methods can be used. One category consists of methods based on useful life defined in terms of time. Some of the year's digits and declining balance are accelerated methods, which means more depreciation is taken in the earlier years than the later years. You'll see examples of these in the next slide. And straight line allocates the depreciable costs equally over the life of the asset. This is the most widely used method. Another category consists of methods based on useful life defined in terms of activity measures. With units of production, the depreciable cost is allocated over the total units estimated to be produced during the life of the asset. These are considered output measures and can consist of such measures as pounds and tons of output. Input measures can be used to allocate the depreciable cost over such activity measures as the number of hours or miles an asset will operate during its life. Almost any allocation method can be used as long as it is systematic and rational. For example, depreciation can start with an accelerated method and then switch to straight line midway through the useful life. This would be considered the method and not a change in methods. But what if one depreciation method is changed to another? Is this considered a change in an accounting principle requiring it to be reported retrospectively? The answer is no, because this would be considered a change in a principle that is inseparable from a change in estimate. In other words, such a change would be treated as a change in estimate and therefore reported prospectively. As described in the previous chapter, depletion is added to the cost of inventory as a product cost. Natural resources are depleted on a straight line basis. When equipment is involved, you'll recall what was described in the last chapter about whether the equipment has an alternative use. Amortization of intangibles can also be a product cost or period cost. Intangibles are amortized on a straight line basis. If a period cost, the amortization is allocated on the basis of time. As previously described, the time can be based on legal life or useful life. It might even be based on the length of a contract. Assets are rarely purchased at the beginning of the year in which a full year of depreciation will be taken. Therefore, it is more common for assets to be depreciated for partial periods of a year. Take a look at the following facts. The purchase of equipment on April 1st means that it will be used for 9 months or 3/4 of a year. Straight line depreciation is the easiest to use. However, let's examine double declining balance depreciation. You'll recall from Accounting 350 that we used double the straight line rate. In this case, that would be 40%, which is double the 20% straight line rate for 5 years. You'll also recall we don't subtract the salvage value of $1,000 until the last year. For year 1, we compute depreciation for 3/4 of the year. In year 2, we complete the remaining 1/4 year before reducing the book value to $6,000. You must always take a full year of depreciation before reducing book value to its new balance. We then compute depreciation for the remaining 3/4 of the year using the new book value of $6,000. Total depreciation for year 2 is $2,800. Another accelerated depreciation method that can be used is sum of the year's digits depreciation. The first step is to compute the sum of the years for the useful life. We could do this by adding 5 plus 4 plus 3 plus 2 plus 1. But using a formula in which n equals the useful life is much easier. The sum of the years is 15. We begin with a fraction in which the numerator is the remaining useful life at the beginning of the year, and the denominator is the sum of the years. We also do the 3/4 and 1/4 split. Notice that we subtract the $1,000 salvage value from the $10,000 cost. The $9,000 is our depreciable cost. In year 2, we complete the remaining 1/4 year before using a new fraction. You must always take a full year of depreciation before reducing the numerator. There are easier ways to compute depreciation for partial periods. One is the half-year convention, in which a half year of depreciation is recorded in the year of purchase, no matter when the asset is purchased, even if it is the last day of the year. There is also the modified half-year convention, in which a full year of depreciation is recorded in year 1 if the purchase is made anytime during the first half of the year, and no depreciation if the asset is purchased during the second half of the year. For tax purposes, the Modified Accelerated Cost Recovery System is used. The acronym is MACRS, M-A-C-R-S. Tables are used to compute depreciation, and salvage value is not used. Depending on the type of asset, one possibility is to use straight-line depreciation. Another is to use the equivalent of the half-year convention and the double declining balance method, switching over to straight line midway through the life of the asset when straight line is greater. There are other ways to simplify the record keeping for depreciation. One of the best is group and composite depreciation. Group combines similar assets that have approximately the same useful life. Examples are all delivery trucks, or all desks, or all chairs, or all computers. Composite combines related but dissimilar assets that have different useful lives. Examples are all equipment in a factory, or all office furniture, or all technology equipment. Both methods are accounted for the same way. In the first year it is used, depreciation must be computed individually for all assets that are being combined. In our example, we have done that for X, Y, and Z using straight line depreciation. Total depreciation for this year is $2,100. From looking at the useful life of each asset, it appears that the composite method is being used. The next step is to compute a depreciation rate by dividing the depreciation of $2,100 by the $15,000 total cost of all the assets. Once we have that rate, we multiply it by the total cost of assets each year to compute depreciation. For example, if next year the total cost of assets in this pool is $20,000, we would multiply it by 14% and record depreciation expense of $2,800. The only time this rate needs to be changed is if something has been added that would create a material change in depreciation. What happens when an asset is sold? Let's assume we sell asset X for $3,500. All we know about X is its cost of $5,000. We don't know its accumulated depreciation or book value. Therefore, we can't record a gain or loss. As a result, we assume that the difference between the $5,000 and $3,500 is the amount of accumulated depreciation that comes off the books. The following two slides are ones you saw in Accounting 350. An asset can be disposed of by selling it, exchanging it for another asset, or just giving it away for nothing. You'll recall that in order to find the gain or loss on the disposal of an asset, we must first compute the asset's book value. Book value is the difference between the original cost and accumulated depreciation. In other words, it is the part of the cost that has not yet been depreciated. In our examples, we'll assume that the asset is sold. We'll start with the cash received. If the cash received is greater than the book value, we report a gain. If the cash received is less than the book value, we report a loss. In our example, we'll assume two different cash sales transactions. Cash received of $5,000 and $1,000 for the sale of the asset. In both cases, we'll assume a book value of $4,000. In the first transaction, there is a gain of $1,000. In the second transaction, there is a loss of $3,000. The journal entry for the gain removes the accumulated depreciation and equipment from the books and records the cash and the gain. The gain is reported on the income statement under Other Revenues and Gains. For the loss, the journal entry is almost the same except for the lower amount of cash and the debit to the loss account. The loss is reported on the income statement under Other Expenses and Losses. How about a yogurt break? Looks good, doesn't it? The next topic we will examine is the non-monetary exchange of assets. Let's assume that we have a yogurt shop and our machine can dispense 3 flavors. Business is good, but it could be better if we had more flavors. Therefore, we trade in our old yogurt machine along with cash for a bigger yogurt machine that has 8 flavors. As a result of this change, would our future cash flows be significantly different with the new machine than the old? The answer is obviously yes, because we'll do a bigger business. As a result, we would describe this transaction as having commercial substance. What is commercial substance? That's what we're going to look at next. The yogurt example just described is considered a non-monetary exchange. Even though cash is involved, the cash is not a material part of the transaction. The only purpose for the cash is to balance the fair value of the exchange. Cash and a small yogurt machine in exchange for a large yogurt machine. Equal value for equal value. When the exchange has commercial substance, the general rule is that the asset received is recorded at the fair value of the asset given up. In our yogurt example, the new yogurt machine would be recorded for the fair value of the old yogurt machine plus the cash paid. There are 3 exceptions to this fair value general rule. If any one of these exceptions exists, the new asset is recorded at the book value of the old asset given up. Exception 1 exists when the fair value is not known or reasonably determinable. Exception 2 exists when the exchange is made to facilitate a sale to a third party. For example, the Alpha auto dealer has a customer who wants a red car, and the Beta auto dealer has a customer who wants a blue car. Each dealer has the color that the other needs. Therefore, they exchange the red for the blue. When the exchange is made, the dealers retain the old book value of the car given up. Exception 3 exists when the transaction lacks commercial substance. You exchange your pickup truck for another pickup truck. Does this exchange have commercial substance? That's a judgment call. Factors to consider are mileage, condition of the engine, age, and how it's used. If all of these are similar, The transaction probably lacks commercial substance because it is not expected to have a significant impact on the risk, timing, or amount of future cash flows. By the way, in our examples, when we use the terms future cash flows, we will mean the net amount of cash inflow minus cash outflows. Before we continue, there are some new terms you need to become familiar with. The word basis, B-A-S-I-S, is the tax meaning of book value. The word boot, B-O-O-T, means cash, and as previously stated, cash is used only to balance the value of an exchange. The word consideration means all cash and other assets given or received. When recording a non-monetary exchange, we need to compute two things: the gain or loss, if any, and for how much to record the new asset. The gain or loss is the difference between the fair value and book value of the assets given up. In other words, it is almost as if the old asset is sold for its fair value. A loss is always recognized. There are no exceptions. A gain is always recognized if the exchange has commercial substance. But there are exceptions when the exchange lacks commercial substance. One exception is when there is no boot, the gain is not recognized. Another exception is when boot is given, like with the yogurt example. Again, the gain is not recognized. It gets a little more complex when boot is received. In such a case, two possibilities exist. If the boot received is equal to or greater than 25% of the consideration received, all of the gain is recognized. If the boot received is less than 25% of the consideration received, only a partial gain is recognized. We will look at an example of these in a future slide. It looks like a lot of stuff going on here, doesn't it? But all of this can be summarized quite simply as all losses are recognized. All gains are recognized, except when the exchange lacks commercial substance. In that case, the gain or partial gain is recognized only when cash is received. How much gain is recognized depends on how much cash is received. The next question is, for what amount do we record the new asset? If the exchange has commercial substance, or the boot received is equal to or greater than 25%, the new asset is recorded at the fair value of the old asset given up. To this new basis, two adjustments might need to be made. If boot is paid, it is added to the basis. Paying cash adds to the cost of the asset. If boot is received, it reduces the basis. It is as if part of the asset has been sold for cash, and when you dispose of an asset, the cost is taken off the books. If the exchange lacks commercial substance, the new asset is recorded at the book value of the asset given up. To this new basis, four adjustments might need to be made. We have already described the first two. The other two adjustments are to reduce the basis by the amount of any loss recognized and increase the basis by the amount of any gain recognized. Why do we make these last two adjustments to the basis? Let's look at the loss first. Remember, these examples lack commercial substance. EQO stands for the old equipment, and EQN stands for the new equipment. Assume that the old equipment has a book value of $100 and fair value of $90. If the equipment is exchanged, a loss of $10 is recognized. Assume that a few days after the exchange, the new equipment is sold. The book value of the new equipment would be the same $100 as the old equipment. The fair value of the new equipment would also be $90 because if it weren't the same, cash would have been part of the exchange to balance the fair value. With a fair value of $90, assume that the equipment is sold for that amount. This would result in a loss of $10. But didn't we already recognize this same $10 loss when we made the exchange? We certainly can't recognize the same loss twice. Therefore, how can we avoid recognizing this loss a second time when we sell the equipment? The answer is, if we reduce the book value by $10 from $100 down to $90, no loss would be recognized when the equipment is sold for the same $90. This is why we subtract any loss that has been recognized, so that we avoid recognizing it a second time when we eventually sell the equipment. Next, let's look at why we add back the gain to the basis. Assume that the old equipment has a book value of $100 and fair value of $110. If the equipment is exchanged, a gain of $10 is recognized. Assume that a few days after the exchange, the new equipment is sold. The book value of the new asset would be $70, which is the $100 book value of the old equipment minus the $30 of boot received. The fair value of the new equipment would be $80. Why $80? Because value of $110 was given up in return for cash of $30 and the equipment. If the exchange is equal, the fair value of the new equipment must be $80. With a fair value of $80, assume that the equipment is sold for that amount. This would result in a gain of $10. But didn't we already recognize this same $10 gain when we made the exchange? We certainly can't recognize the same gain twice. Therefore, how can we avoid recognizing this gain a second time when we sell the equipment? The answer is, if we increase the $100 book value by $10 and reduce it for the $30 of cash received to a new book value of $80, no gain would be recognized when the asset is sold for the same $80. This is why we add any gain that has been recognized, so that we avoid recognizing it a second time when we eventually sell the asset. You might need to review these examples a few times before it clicks. Over the next 4 slides, we are going to cover 10 examples of non-monetary exchanges. We'll start with the following facts and then make additional changes to the facts as we go along. Notice that the book value of the old equipment is $10,000, which is the difference between the original cost and accumulated depreciation. In the first example, there is no boot, the exchange has commercial substance, and the fair value of the old equipment is $14,000. The new equipment is recorded at the fair value of the old equipment. The old costs and accumulated depreciation are taken off the books. This removes the book value of $10,000, and gain of $4,000 is recorded. The facts are the same in the next exchange, except that it lacks commercial substance. The new equipment is recorded for the same book value as the old equipment, and the remainder of the entry is the same, except that the gain is not recognized because the exchange lacks commercial substance. In the third exchange, we'll assume that the fair value of the old equipment is $9,000. You'll recall that all losses are recognized. The loss is recorded as $1,000, the difference between the $10,000 book value and the fair value of $9,000. The new equipment is recorded as $9,000. There are 2 ways to compute this amount. If the exchange has commercial substance, the new equipment is recorded at the fair value of the old equipment. If the exchange lacks commercial substance, the new equipment is recorded at the book value of the old equipment minus the loss recognized, and the remainder of the entry is the same. In the next three examples, the exchange will include the payment of $2,000 boot. The first exchange has commercial substance, and the fair value of the old equipment is $14,000. Notice that if the fair value of the old equipment is $14,000 and $2,000 is paid, the new equipment must have a fair value of $16,000 in order for there to be equal value for equal value. The new equipment is recorded at the fair value of the old asset plus the boot paid. Cash is credited, and the old costs and accumulated depreciation are taken off the books, and the gain of $4,000 is recorded. The facts are the same in the next exchange, except that it lacks commercial substance. The new equipment is recorded for the same book value as the old equipment plus boot paid, and the remainder of the entry is the same except for the gain. In the third exchange, we'll assume that the fair value of the old equipment is $9,000. The loss is recorded as $1,000. The new equipment is recorded as $11,000. There are two ways to compute this amount. If the exchange has commercial substance, the new equipment is recorded at the fair value of the old equipment plus the boot paid. If the exchange lacks commercial substance, the new equipment is recorded at the book value of the old equipment plus the boot paid and minus the loss recognized, and the remainder of the entry is the same. In the final set of examples, the exchange will include the receipt of $2,000 boot. The first exchange has commercial substance, and the fair value of the old equipment is $14,000. Notice that if the fair value of the old equipment is $14,000 and $2,000 is received, the new equipment must have a fair value of $12,000 in order for there to be equal value for equal value. The new equipment is recorded at the present value of the old equipment minus the boot received. Cash is debited, and the old costs and accumulated depreciation are taken off the books, and the gain of $4,000 is recorded. In the second exchange, we'll assume that the fair value of the old asset is $9,000. The loss is recorded as $1,000. The new equipment is recorded as $7,000. There are two ways to compute this amount. If the exchange has commercial substance, the new equipment is recorded at the fair value of the old equipment minus the boot received. If the exchange lacks commercial substance, the new equipment is recorded at the book value of the old equipment minus the boot received and minus the loss recognized, and the remainder of the entry is the same. The next exchange lacks commercial substance, and the fair value of the old equipment is $14,000. You'll recall that when boot is received and the exchange lacks commercial substance, all or part of the gain is recognized. It depends on the 25% test for boot received. As you can see, the $2,000 of boot received is less than 25% of the total consideration received of $14,000. The actual percent is multiplied by the total gain of $4,000, and the $571 is recognized as the gain. The new equipment is recorded for the same book value as the old equipment minus boot received and plus the gain recognized, and the remainder of the entry is the same. Let's change these facts. Assume that the amount of cash received is $3,500, not $2,000. When we use the 25% test, we find that the boot received is 25% of the total consideration received, which means it is equal to or greater than 25%. Therefore, we recognize the total gain of $4,000. Notice that this is the entire gain, not just 25% of the gain. The new equipment is recorded for the same book value as the old equipment, minus boot received and plus the gain recognized. And the remainder of the entry is the same, except that the cash is debited for $3,500.